Hi, everybody. Scott Riley, the Market Update Desk, July 31st. How was it the end of July and almost the start of the dog days of summer? It's pretty crazy. NMLS 157524. We had a bunch of data come out yesterday we're going to break down and information from today. So let's dive right into it. We had the Fed meeting yesterday and obviously did exactly what everybody thought. There was a pause. So rates stayed. Now, this is on the Fed funds rate. This does not affect mortgage rates. There's not a direct correlation, that is. So the Fed funds rate is going to stay between 4.25 and 4.5. We did get also what we thought. Two Fed governors, Waller and Bowman, dissented and were in favor of a quarter-point rate cut. Now, remember, that's the first time two governors have dissented in 32 years. That's a pretty interesting effect. What it shows is maybe there's going to be more discussion and not conformity within the Fed meetings, which is a positive thing. Now, their statement said that growth of economic activity moderated in the first half of the year, which was a change from the previous statement that the economic, saying that it expanded at a small pace. So a little bit of an improvement within the language. And remember, it's very important to look at the language and its subtext within Powell's statements and his Q&A. Powell estimates that annualized GDP through the first two quarters is a mean average of 1.2%. When you factor in the pull ahead from Q1 and Q2, which we'll go through in just a minute. On tariffs, he thinks that there'll be shockingly exactly what we've been talking about, a one-time price increase, but yet they've never acknowledged until now. This is one of the reasons they really need to be cutting rates now rather than playing from behind the ball. Powell acknowledged that the Fed actually is restrictive, and on the labor market said that if you take the QCEW, the quarterly census on earnings and wages adjustments seriously, the U.S. may be a net zero sector growth. So he finally came out and talked about that QCEW and the adjustments to the BLS jobs report that we've talked about for so long, and that the Fed really is starting to pay attention to that net number after these adjustments. Lower income households saw credit card spending decline in the first 3 months through June for the first time in over a year. So that's kind of a breakdown on the Fed meeting. The market is really anxiously waiting the September meeting, which is the next one, thinking that that will be the time that we get a rate cut. The other data we got yesterday was first look at Q2 GDP. That came in at a higher than expected at 3% month, a quarter over quarter, versus the market expectation at 2.3%. Consumer spending came in at up 1.4% versus quarter one that was only 0.5%. We did see exports decline 1.8%. Now, the internal PCE number for the GDP came in at 2.5%, which was lower than expected. That's an internal number within the GDP report. Our next data point is the ADP jobs report. Last month, if you remember, it was only about 32,000 jobs. This month was more than expected. The market planned on 64,000, but we got 104,000 in the ADP payroll. Leisure and hospitality led the way, which was a little surprising, at 46,000 jobs. Financials came in at 28,000 jobs, and medical and medium and large size businesses grew by 46,000 jobs, while the small business under 50 only had a net 12,000. So we're seeing small businesses are still struggling. Health and education were the losers in this report, down 38,000. Now it'll be interesting to see what BLS says, because that's the number that seemed very fuzzy in the last BLS report to give a positive number when it did not make sense at all with state and local education jobs in the public sector having an explosion of growth. So it's going to be interesting to get that in the BLS tomorrow. Now, today we got the PCE, personal consumption expenditure, the Fed's favorite measure of inflation. Headline inflation came in at 0.3%. That was where the market expected. And year over year rose to 2.6%, which was a tenth higher than expected. And that's really because of the previous month's adjustment of plus 1/10. Now, core, which takes up the volatile food and energy, and that's really the Fed's focus is the core, was at 0.3, which was also in line with expectations. Go back to my notes here. So the year-over-year core inflation remained at 2.8%. This on the heels of a revised previous month, up 1/10 from 2.7 to 2.8%. Now, the shorter run rate 3-month core rate rose from 2 to 2.6, which is not great. So we've got a little bit of a question on that. The 6-month increased slightly from 3 to 3.1%. We did see personal incomes do a little bit of a surprise, and that came in at up 0.3, 1/10 stronger than expected. We did see spending rise 0.4, which was 1/10 weaker than expected. So a little bit of balance there between the earnings and spending. Bottom line, the bond market took pretty much all these reports in stride and were pretty flat today. In fact, the 10-year is down 1 basis point. It's almost as flat as what we can see. Now, one thing we're going to talk about and pay close attention to, it's going to be really hard to make progress the rest of the year until we get to January, February next year, 26, to make headway on the core inflation. And that's mainly not because of tariffs or higher inflation, but because the replacement values from last year. Next report from today was jobless claims. We saw initial claims rise by 1,000, and that came in relatively decent, total 218,000. Continuing claims, though, are still elevated. They were unchanged at 1.946 million, still approaching and hovering around that 2 million threshold barrier. When we look today, the bond market is set up again for a rally. This has happened last 3 job reports, but we've been blunted by the jobs report each of those 3 times. We keep getting down to the resistance level of 4.33 and then get the jobs report and bounce right back up from it. Right now we're hovering at 4.3581. So we're going to pay close attention to that jobs report. It's a little bit of a concern with ADP coming in what it did, and what are we going to see from that jobs report. So be very careful. We'll watch it closely. We'll do a quick morning update and then an afternoon one tomorrow. Scott Riley, the Market Update Desk, your original singular market news source for West Michigan. Enjoy the afternoon. 616-293-2189.